Welcome to the channel again. And today's stock is called VF Corporation, ticker VFC. This is a company that is one of the largest retail brands in the world. If we take a look here, uh, description, what do they do? Well, with its subsidiaries, they engage in design, procurement, marketing, and distribution of lifestyle apparel, footwear, and related products. So the kind of brands that they have are well known. I think the strongest one is the North Face, but they also have other interesting brands like Timberland, Marble, Icebreaker, Ultra, Vans, which we're going to be talking about, Spring, Kipling, and a few others. Now, we go back to the chart. We can see that this is a company that has struggled since the pandemic. Where we are now is, if you have a look here, we are sitting just above a multi-year key support level, right? So you can see around 2008, we had this major key resistance that was also reinforced over here. And then the stock went up. This is COVID, right? Which is now been broken. This resistance this support level here at around $38, $40, maybe 35. You see how that is taking place in 2017, in 2015. So that's been broken now, and we're sitting just above here. And at the same time, what we have is very bearish sentiment on this stock. So 7%, which is not huge, but you see how it's been creeping up over 2022 up to this day. So currently we're near the all-time high for bearish sentiment. If we look a bit closer, we were getting just above the SMA 15, but very shy, coming in, and then we are out of that again. And the reason why that happened is because the company reported earnings recently. So that happened just here, 6th of February, so a couple of weeks ago, and the company missed earnings by 27%, which is pretty big. Now, probably catching your eye as well, the fact that this is not the first EPS that they've missed, right? So they've missed plenty of quarters since 2020. And the thing is that the earnings report in this quarter was not very encouraging either. So we have revenue down 16%, gross margin, yes, increasing 40 basis points. However, the operating margin was down 560 basis points. And we already said that the earnings was a miss. Now, if we look at the brands, the four key brands are Vans, which has been struggling for a long time. At the moment, the company is in the middle of a management operating plan to turn around this brand, but it's really struggling. So that's down 29% in revenue. North Face down 11% in revenue. The company declares that is partly due to a weaker winter season, but guess what? We are kind of through the winter season when it comes to sales already. Like, you know, if you're gonna be buying winter sports wear, you probably have done that by the time of the year. We're in the middle of February now. The brand is finished strong, but yeah, even that brand, which personally I love, is down. Timberland is also down 22%, and then Dickies is down 17% as well. Now, when we look at the breakdown in terms of revenue per region, APAC is up 3% surprisingly, which is overall positive, but not massive. But here's the kicker, right? The revenue in both EMEA and Americas is down 12 and 25% respectively, and that's huge. Especially bearing in mind that whilst the consumer is under pressure, we have seen how for example, the UMCSI, the University of Michigan Consumer Sentiment Report, has already troughed and is starting to pick up a little bit. So this is giving us some proof that whilst the consumer is recovering, starting to recover, this company is not quite turning around itself. And then we have the revenue by distribution channel. So direct to consumer is down 9% and wholesale is down 28%. So where does this leave us looking at 2024? Well, the guidance has been adjusted. On the free cash flow stays the same. Liquidity improves a little bit from 2.2 to 2.3 billion. But here's the interesting thing. The inventory was expected to be negative mid to high single digits. And now they're saying that it's going to be at least down 10%, right? So the inventory is down. And even if the company manages to sort out these issues that they're having, well, they're not going to have inventory really to sell merchandise out there. They don't have a problem of inventory. This is a problem that they had in the past, but they mitigated that. So it doesn't seem that even if they manage to sort out these issues with margins, operating margins, uh, we are looking at a earnings growth story. As a matter of fact, it's not a revenue growth story either because in 2024, they're expecting a 0.51% revenue growth, which is negligible. Okay. So, um, what else has happened with the stock? Well, the underperformance of the company has led to a number of things. So, for example, there have been two major dividend cuts, lowering the dividend by 70% to 9 cents per share. And that is going to be the next date for ex-dividend is going to be on 11th of March, which if we look at, for example, the stock going up to these levels, where just under the SMA, I would probably look as a potential entry point as a short, and I'll explain later why. But overall, what we can see is that the company is struggling a lot. The EBITDA margin and net income are deteriorating. They also have high levels of debt, so they're currently sitting at almost 230% debt to equity, which is one of their main priorities this year. They're looking to deleverage the balance sheet. And to do that, they know that they have to execute a turnaround plan. Now, they are addressing that by things that they haven't really quite fleshed out. They talk about delineating a clear brand purpose, focusing on innovation, and implement targeted marketing strategy. But at the core, the tangible aspect is that they're delivering, they're working to deliver a cost-saving project of $300 million, which according to them is completely down to their control. So management in their last earnings call sounded quite optimistic about the future, while it's also addressing the improvements that are necessary to take place. So in terms of risks, if I was looking at this, and I am as a short, I think that would be probably the biggest one to mention. So In terms of the financial performance for this year, they expect 600 million in free cash flow to be delivered, and that's around 9% of the market cap, which is quite high. Now, that can be potentially the downfall of the stock in the near future because that's certainly very high expectations. And also the earnings growth expectations for this year is rather high. They're expecting earnings growth. This is small numbers, right? So obviously it's elevated from year on year, but they're expecting that to be just under 25%. Now, what happens if those expectations are not met? Okay. It could be possible that they do deliver on that plan and they save that 300 million and they also deliver that free cash flow of 600 million. Okay, that would likely affect positively the stock price quite a bit. But let's say that they find those challenges ahead and they fail to do so. Well, the market seems to be thinking that those issues are not going away. We see how, for example, the short interest has increased from 660 to 7.7, almost 7.7. Now, this, yes, of course, likely going to be due to the earnings miss news, but let's not forget that this is a stock that has been shorted for years now, all right? And the short interest just keeps going up. So the market seems to perceive it as farther downside to be found here. Now, how much lower it's going to get? Because admittedly, we are pretty low price already, 15 cents, excuse me, $50, 30 cents. Well, I'm looking at this from a perspective of next 12 months PE ratio, okay? With the recent miss, which is actually good in this instance, you can see how the valuation has gone from around 9.7 times to where it is now at 12.8. So that means that if things continue to get tough, if they find more headwinds, there is room for the valuation to go down. Let's pretend that we go back to the levels that we were here at 7.5 times, right? That's typically where the stock has been sitting historically. So let's remove 2021, 2022 because that was a period that was quite strange. Let's look before 2020, right? So the stock was sitting at levels that aren't coming back. There's no reason to think that they're going to be coming back. And if we look even further, yes, it's not that far off. So probably the kind of price that I would be looking on as a price target is going to be $9. So for that to happen, we need to break this barrier here of $12. And let's not forget that is a really, really long-term support level. So how long will that take? Well, likely months. This is not a trade that we are going to put anytime soon. It's definitely going to sit on my watch list. And we'll likely keep an eye on the developments that take place in the industry. I would also like to enter at slightly higher levels, but for that to play out, breaking that barrier that we just mentioned, I would probably select a time horizon that is at the very least 3 months, but more likely 6 months or even more. So it's something I'm going to keep an eye on. If we wanted to enter now with a longer view, I would probably go along the August 16th puts and short the June 21st puts on a calendar with a 15 strike. The price of those is actually very reasonable. You can do a calendar on a ratio for not much money and restructure later. That's an option. But for the time being, I would like to see a better entry point, potential the stock go above, if possible, this moving averages and see if I can increase my price target from, say, low 20s to mid-teens. I think that's also a possibility if perhaps rates are decreased. So we'll keep an eye on this one. Thank you for coming and see you soon.